Lots to chew on this morning. Tech heavyweights Meta, Microsoft and Tesla reporting results and profit topping expectations. But gold, of course, in record territory again, nearing $5,600 US for the yellow metal, and silver hitting its own record highs. Let's get perspective from Lyle Stein, president of Forvest Global Wealth Management. Lyle, great to see you. Can we start off with gold? I mean, that is in a way an alarming sign, isn't it, that people are retreating to this asset?
Well, it is a sign that people want a security blanket. They're looking for some protection from all the geopolitical concerns, all the potential inflation concerns, a whole bunch of reasons. But it goes even beyond gold in some respects, Andy, because you're looking at big moves in other commodities. Silver, you mentioned. And as you go down the list, copper, and even the last week, we've had oil run. These are all hard assets. And from a portfolio manager question, it's interesting. What do you do with all these hard assets?
What do you mean? What do you do with them? How do you play them?
Exactly. So, I mean, look at pick a chart. It doesn't really matter which one, but we might as well go with gold because that's 54.50 or whatever it is today. The stock has gone what we refer to as parabolic. It just looks like that old hockey stick, right? Where it's got a short shaft and then a long staff.
Yes.
It's interesting. But how do you play this? What do you do in the context of a portfolio with gold stocks, but with commodity stocks, hard asset stocks in general? And it's a big question. Now, as you know, we've held gold in our client portfolios for a long time. It's been a wonderful place to have been. But today, at current gold prices, what do we do in our portfolios? And, we believe gold has two roles. It's got an insurance component, and then it's got sort of a investment, call it momentum mode. That's more the stocks as opposed to the insurance is the hard bullion asset. And so in our client portfolios, what we're actually doing is taking some of the wonderful gains that we've made in our gold stocks and moving it more into the insurance component. And so, when we think of gold positions, roughly we're 10% in the gold commodity, the insurance, and 15% in the stocks, where we had been shifted much more towards the stocks over the course of the last 2.5 years.
That's interesting. So, sorry, just make sure I have that clear. You still have a good weighting in gold, the metal, but you're moving into the stocks. So you're overweighting the stocks right now, relatively speaking?
Other way. So we had been much more exposed to the stocks because of the leverage you get from the operating businesses. But now with gold running the way it's been running, we're leaning more to how do we get more insurance into the portfolio? So let's own the bullion directly.
Right. Copper is on fire as well. And apparently a lot of that is speculative activity in China. Copper topping $14,000 US a ton for the first time and surging in US trading as well, as we can see, up 10%.
Yeah, and we see that as a result of two factors. Number one, the world's central bankers, the world's politicians are doing what's called running the economy hot. They're putting fiscal stimulus in, and they're trying to keep interest rates low. And so you've got this whole demand side into a world of copper mining where there just isn't mining capacity to meet the demands for AI needs, for electrification needs through the entire grid. And so what happens is the commodity stock goes up. I mean, I can't explain the kind of moves that goes from 6 to 653, essentially overnight. But the basic copper story is that it's in long-term deficit supply. So prices will have a bias to go up in that environment.
Yeah, Bloomberg is saying today that copper is being fueled by intense speculative trading in China, and people who have no interest really in copper as a metal piling in because they see momentum here.
And I'm not going to cast judgment, but silver is kind of in that same camp too.
Right.
It's an industrial metal. It benefits from economic activity, but there just isn't enough physical silver to meet the needs of the speculators when they're in the market transacting every day. And so what happens? You get these parabolic moves. And the question is, it's wonderful to ride on the upside, but we all know what happens on the downside, and it tends to fall quite quickly as well.
It looks as though the tech earnings, broadly speaking, were pretty good.
Yeah, well, it depends on the company, right?
Right.
You know, we had Meta on the upside,
Yeah.
but the big one is Microsoft, which markets weren't too happy about. Now, we own neither of them, but we were looking for in those numbers is what are they saying about capex? Because the whole AI capex spending boom has been driving not just the stocks, but you know, the U.S. economy. They say half the growth is coming from AI spending. And you know, Meta, which was in the doghouse not too long ago because they were going to spend more than the anticipated revenues, is now going to continue the spend, but everybody's happy because they had revenue growth. On the other side, on Microsoft, you didn't see the growth that people were looking for in their cloud business, and they didn't like that. So, you know, the world is changing there, and it is becoming much more, I think, and this is perfectly indicative of what we refer to as a stock picker's market. We own Amazon, Google, and Micron. We're looking at these names carefully in the context of what Amazon and Microsoft are saying with respect to capex, because it impacts everybody.
It looks an interesting. I'm actually looking at the story on this Microsoft in the Economic Times of India. They highlight something that apparently new disclosure revealed that OpenAI accounts for 45% of Microsoft's backlog of 625 million. I presume a lot of that is cloud business, but that's interesting that you're so exposed to a company, OpenAI, whose debt is raising eyebrows among investors.
Well, and that's a big question for the whole sector, is how much debt is being taken in. And in particular, in the case of Meta, you know, Meta is doing the financing of a lot of their development of AI centers off the traditional Meta balance sheet. It's off the books kind of thing. And there are questions as to how willing the lenders will be to continue to provide the kind of capital that Meta needs. I mean, you look at Meta's forecast of what, $115 billion. Just last night, I looked up how much Canada as a country spends on that kind of spending. And in 2023, I think we were at maybe $350 billion Canadian. I mean, Meta is half of that for all practical purposes. It's quite amazing how much money is actually being spent. And, you know, if they build it, will they come? We've all seen the movie.
Yeah, Meta. So they're now forecasting their capex will jump, my goodness, this year. I believe it's this year. Yeah, a capex of up to 135 billion at the top end, almost twice last year.
It's a massive number. And that's just Meta. I mean, then you throw in Google, you throw in Amazon, you throw in Microsoft. Microsoft, I think, said they're going to spend about 35 billion. Don't quote me on that, but I mean, these are massive numbers.
Yeah. It's interesting. Just one, this is a bit off topic with Meta, but we keep hearing about these ads running on Instagram, with not just Instagram, other platforms, but in this case, Instagram, fake ads. And Meta doesn't seem to be able to stop that if they are interested in doing it.
Interesting. Well, I guess if they're fake and they bring in money, I mean, look, there's a whole bunch of questions that are involved in there. But the big issue is that real money? You know, go back to the movie. They're building it, but what will the revenue be when, in fact, they come? And then the business models are changing at the same time. Data centers are very capital intensive. And, you know, Meta, Facebook was a software company when it first started. The margins for capital intensive businesses are much higher, but the cost of capital is a big component, and depreciation expenses going forward are huge numbers.
That's interesting. Yeah, they're far less virtual companies than they used to be. Yeah, they're going to have these huge, and stuff depreciates. I know the industry says, well, we can use the chips for other stuff, but this stuff does lose its relevance pretty quickly.
It is interesting. And Andy, I'm kind of thinking about, so the Bitcoin miners, what's the difference between a Bitcoin miner and a copper miner? I mean, you got to spend a lot of money, and how long do you get of an asset life once the capital is employed? And in the context of AI chips, where all the money seems to be going, they have short lives. Gold mines, you know, a good gold mine's got a 30-year mine life.
Lyle, thank you very much indeed. Lyle Stein, president of Forvest Global Wealth Management.